Got signs that U.S. inflation is moving in the right direction and major equity markets have been pushing to new highs. But you also have the Fed indicating that we may only get one rate cut from them this year. So can this run in equities continue in a backdrop like this? Joining us now to discuss is Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, great to have you back on the show.
Great to be here.
Interesting times whenever you and I get together to talk about what is happening out there. So give me your view on what is happening right now.
The irony is, and I think we'll probably touch on this a little bit, if we rewound and look at an interview when I did back in January, the gist of it was we're expecting 6 to 8 rate cuts, and that's what we were talking about. And you know, along the lines of if we started talking about, well, boy, what would it look like if there were none? And you know, if we kind of look at that era of going back in January, I think like a response, like on a consensus response would be, well, we would be in a very dire place indeed. And you know, well, here we are in the second week of June, and we're in a lot of places, but dire isn't one of them.
And right? By the look at the equity markets.
Yeah. So I think kind of the start of this is I would look at it is if you know. A couple nights ago, I had the privilege to get out and do some speaking with a bunch of our clients and answer questions. And one of the things was I said, you know, like, let's step back a little bit and let's just do a run over the last couple of years and think of the things, right? Like we've had a war breakout in Russia and Ukraine. We've had a war breakout in Israel and Hamas. We have had runaway inflation at one point at 9%. And of course, that's now come off a bunch, but we'll get to there. We're working our way out of a pandemic where we stalled the economy, all of those things. And you would think, okay, well, where are we right now? Well, okay, we're record highs to your thing on the S&P 500. And we're in an environment where much of what we'll talk today is about interest rate cuts to try to kind of slow things down a little bit. And so the remarkable place, I think, where we are right now is if we added it up and said, in an environment like this, which you'd map out, let's just think about first in terms of volatility, things going up and down. We have understandably seen a lot of interest rate volatility, and check, and that makes a lot of sense with the inflation environment. Next one, equity volatility. There is none.
Yeah.
I mean, it oscillates between 12 and 16. Sometimes in a crazy day you'll see 20, but then it's back down to there. And I think the messaging around that is that one of the things we're going to continue to do if we look at the years coming ahead of us, and you and I've talked a lot about this, there is going to be angst and anxiety, and there is more strain and pressure in this world right now. And if we look at commodities volatility, same piece. And so if you look, for example, we could look at right now as a thing that we're, because part of our job is to think about where the risks are and where volatility could come from. When we look at Russia, Ukraine, and we look at the activity in Russia, that we do the scenario analysis of where we think that is, and we haven't increased that as an escalating part of an area in war. But what we have seen in Russia is escalation of the use of tactics that are on the fringe, but as a whole enables them to avoid using and drawing in NATO powers into the war there. But it does have the process of escalating the activity that is happening geopolitically in the globe. While that's going on, volatility is just non-existent, right? And I don't need to dig into Israel and Hamas to go, they can look at them and you can see that happening. So you have to step back for a minute and say, well, why isn't there any? And because
why? Because they're kind of thing. If you were sitting in a classroom 2 or 3 years ago and they said, if this was happening, this was happening, this was happening, what do you think would happen to the equity markets? And you probably would have got full points for saying, oh, it would be a choppy ride.
Right. And one of the things I've tried to explain to in this client event I was speaking at was to say that, you know, one of the realities is that in an economy, and even in times of during warfare, is that people still get up, they still shop, they still have to buy groceries, they still have jobs, governments still function, governments still need to borrow, so it means there's government debt markets and borrowing goes on and economies continue to move. And so one of those is just a structural reality of these are one of the pieces that would go on. And I think that's a good starting point. And the second one goes along the lines of where we are today is there's the big barometer of trying to figure out ultimately where the economy is going to go down the road, which is going to drive over the long term earnings per share in an equity market, and it's ultimately going to drive which way interest rates are going to go. One was inflation, and it as we saw yesterday in Canada, in the United States, we saw that we're getting into that kind of 3.2 year-over-year number. Kind of surprised at it wasn't soft, but when you dig into it a little bit, we're in a pretty good spot there.
Maybe we're going the right way.
Yeah,
maybe we're going in the right direction.
Right.
Yeah.
Now, the areas of concern are the areas that have been driving that has been labor, and labor continues to be really strong. But if you think about it in terms of it's at 4% now. Now it was at 3.7. Then it was at 3.8 and 3.9. So the direction of that is slowly starting to go up, which is what you would kind of really want to see on that side. And so if we kind of start going through that, the reality is that there's a lack of volatility, and then we'll dig in the U.S. and Canada and all that. But the reality is that there's, from the last few years, still an enormous amount of money in the system. And that money in that system is if you want to think about as the globe inside of a bucket, money's in that bucket and it's still sloshing around. Some of it spills out the sides, but at the end of the day, until it works its way through the system, there's an enormous amount of money already in bond markets able to trade every day, in equity markets being able to trade every day. And then, which I know you've had a lot of people on here talk about this, so we won't dig into this, but then but on the sidelines, there is an enormous amount more of it, of that money creation that is actually just being held off the side, that hasn't entered into the system. And so how do you explain it? It's really down to those things, is that you run on an economy still runs even in the times and periods of angst and elevated war and in crises and times of warfare. And on the other side, that it's just ultimately the law of capital, is that when there's that much there, that much of a supply, how much of the demand on it's going to make it, and clearly from how things are trading, there's still a lot of supports in financial markets globally, and that's why we are where we are today.
How do you allocate then? I mean, I know this is the question ultimately you have to wrestle with. How do you allocate in an environment like this with capital on the sidelines like that?
Well, I think the first one I think you have to look at is that the temptation the temptation of short-term interest rates. If you look at all the options in front of you and you see this great short-term interest rate in a short-term cash deposit or a GIC of some sort, and you go, well, I get 4 to 5%, and there's very little risk in that. Why wouldn't I do that? And I think what I think that your starting point is that almost any measure of what you'd want to talk about, if you wanted to look at U.S., which is maybe the best economic story globally, remember, all our dialogue are still going to be pointed to the desire to have it to slow so that you can start dropping interest rates again. In Canada, we saw Bank of Canada drop interest rates. We saw them and also come out and say, there's more coming, and we've talked a lot about that. These more are coming, so we probably won't see one next month, but we'll probably see a couple after that. And so in Canada, rates are going to go down. And so one of the things is, how do you invest? Is for starting points, you have to look at those cash positions. Remember that as interest rates go down, you put yourself up to reinvestment risk. So, the likelihood interest rates in the short term are lower than they are now, 12 months are exceedingly high. I mean, like you have the governor of Bank of Canada saying, we're lowering interest rates, right? Like there's no crystal ball action going on here. And so I think how do you invest it? The start out is you have to look at that and go, okay, if I'm going to step out, we are currently overweight fixed income markets. We continue to think that fixed income markets here, particularly in Canada, because things are slowed a lot faster than it is in the United States, that you can allocate into fixed income and you can allocate into government bonds, for example. You can get a tremendous yield in the short term, and if you went out and said, I'm going to go out and I'm going to ladder out 1 and 2 and 3, so not pulling out any crazy strategies here, just as simple of doing that. Or if you went and said, I'm going to look at a little bit even higher yield with good if your risk warrants it, right? Good Canadian corporate investment grade securities. Go out kind of 2 or 3 year in something in there, laddering that out. This is one of the historical high and opportunities there. If we wanted to look in fixed income, that alone there is a place to invest. And we think that's for us, we think that makes an awful lot of sense. Why we're overweight fixed income, and I know we'll go through others as well, but that's your starting point. We think that makes an awful lot of sense. And what's the wind at the back of that? The wind at the back of it is that Canada is slowing. The number that we're seeing from the inflation here is we are in and around that 2% zone. When we look across the board, what we're going to see is, I haven't read the new TD economics report that you've had there, but we do work an awful lot. We do an awful like the Canadian consumer. It could be on the margin changing, but at the end of the day, they are stretched. So their spending is going to start to slowing, and that's going to have an impact ultimately on the interest rate market here too.
Quickly, we'll talk about the equity side of it.
Sure. The equity side of it is, I think again, it's back to the, you got to know that technology's been the hot space when you're talking about income packages, like we were off the top of the show here. No secret the S&P 500 is trading at its highs. Looking at that, first and foremost, we think you need to build a diversified investment portfolio. They go, then he's going to sit on the fence. No, look, overall, if you look at the big batch, start as a neutral. When you're at in an environment that we are here, we can be maximum of overweight equities, we're neutral overweight equities. And for much of the reasons that we've kind of mapped out here, there is low volatility. There are high evaluations when you look at the S&P 500 writ large. We'll break that down a little bit. But when we start working our way through that a little bit, we continue to think that being overweight United States makes a lot of sense. We think you want to use a barbell strategy there. So you do want to have those momentum names, and you want to have those that are influenced by the AI and the semis. And now increasingly you're seeing how can the semis benefit the software companies, and what does that look like, and having exposure there. That we think makes a lot of sense to be able to do. What we don't think makes an awful lot of sense, I was going to read this at the punchline, but we're publishing a kind of like an educational piece / update about private capital on Monday. And I have this chart where I go, on all security classes, private capital or private equities outperformed S&P 500, public equities, global equities, all of it. Put all your money in that. No, right? All the environmental things that made that happen during that time may not play out perfectly in the next 3 to 5 years here. And so the principle that we have is that you don't know what the future is going to bring. You hit weights on things and go, how much I want to allocate. There is a lot of wind at the back, and you don't want to stand in the way of what's going on in technology right now. You want to be allocated there. On the other side of the coin, when we look at it in terms of looking at momentum securities versus what we would call quality securities, kind of dividend type of pairs, and looking at small caps, which is kind of more closer to your mainstream and drivers, they have underperformed. Their valuations are quite good. Last time I was on here, I was talking about how the equal-weighted S&P 500 index has started to outperform the S&P 500, which is really skewed to the technology names. That was a real positive. That outperformance is really narrowed after this great run that technology went on in May. That doesn't mean that making sure you're allocating across that spectrum doesn't make an awful lot of sense, and it does. Yeah, how about the other side? If you rewound me here a year ago, I'm drawing a picture of Europe that is dire, and then I don't want to overstate this. It's not like pull out the bottles of champagne and say things are way better, but they're improving. And as they improve with the valuations that they have there, we think that warrants another look. So we have changed our weighting in that area of the world, and so we have more weighting towards there, and we think that makes an awful lot of sense too. And so making sure you're allocating along those lines. And Canada is a little bit like Europe's cousin, right? It has many of the same metrics, kind of the cyclicality on one side, a lot of financials, and so Canada's in a very similar boat to that. So why we continue to be able to think that makes a lot of sense too.